Hello, and welcome back to the pricing channel for small businesses. In our last video, we talked about SaaS pricing, that is, software as a service, and specifically how one might go about pricing a new SaaS product. Now, something we totally ignored in that video was the potential cost of developing a new SaaS product. In fact, in our whole series of videos, we have never talked about the situation where a small business might have to spend a lot of money, like 6 or 7 figures, in order to develop a new product or service. If you're going to spend that much money, particularly if it's borrowed money, you're going to want to make sure that you earn enough money to pay back that investment and generate a return on that investment. If that's the situation that you're in, then how do you go about pricing a product to make sure you can pay back that investment and earn a return on it? Well, that's what we're going to look at next, so don't go away.
1, 2, 3. Virtually all of the pricing strategies we've talked about so far involve maximizing gross margin as our key metric of profitability performance in our business. And certainly this is the best metric to use where the cost of, say, developing our product or service are relatively insignificant. And what we mean by insignificant is that typically, or in many cases, we can develop a new product or implement a new service using the generated cash flow from our business. In other words, we don't have to go out and borrow any money in order to do this. And so in those cases, using gross margin as our metric for establishing an appropriate price is a perfectly valid way to go. Now, the problem comes in where we have to take out a loan or accept investment money or expend capital resources in order to develop a new product and service. And so, for example, what if we had to spend $50 million in order to develop a new product or service? How would we go about pricing the products developed? Well, certainly in most small businesses, the sum of $50 million would not be insignificant. And so we would perhaps be concerned about how to price the product or service we want to develop so that we can, first of all, generate a proper return on that investment and, in fact, pay back the investment itself. So there's 2 ways to look at this return on investment issue. And the first is just a simple rate of return pricing strategy. And we'll look at an example of that. A more involved way of looking at this is what's called the discounted rate of return pricing strategy, where we consider cash flows into the future as part of the income stream that will pay back the investment and generate a return. So let's look at the simple rate of return pricing strategy first. Let's assume that we want to earn a return of X% on our new product service development investment. And so what this means is we'll need to price the product or the service such that we generate enough income to pay back the investment and earn the desired rate of return on that investment. And so the total income supplied by that product or service over some period of time will have to equal the amount of the investment we made plus the X% return on that investment that we desire for the use of our money. So let's look at a concrete example of this. Let's assume that we've received a bid proposal for some entity, to supply 5,000 units of a specific product. We estimate that it's going to cost us $600,000 to develop that product and have it ready for sale. We've decided that we want to earn a 15% return on that invested amount of money. We've also determined that it will cost us $80 per unit in order to build the product so that we can sell it. So the question now is, what price can we put into our bid response to generate the desired return? So first of all, we can calculate the required net income from selling those 5,000 units of product to the customer. And so that total income would have to be the $600,000 to repay our investment, plus the return on our investment, which is 15% of $600,000, such that the total amount of income we need to generate from selling those 5,000 units of product is $690,000. The income per unit that we need to generate is the 690,000 divided by the 5,000 units that we're going to sell, gives us $138 of income from unit. So, given that we know the cost to build the product is $80 per unit, and the income that we need to generate for each unit is $138, that tells us that the selling price that we have to charge the customer for those 5,000 units is $218 a unit. Now, that was a pretty simple example. There was a finite amount of product that was to be delivered, and presumably over a finite period of time. The more complex example of this is where we develop a product and we sell it for a number of years. And over that period of years, the rate of sales might change. The cost of producing the product might change. We could even have the pricing changed. And so in that more complex environment, how do we go about calculating a price that will generate a required amount of return? And so the way we go about doing this is to look at a sales forecast over a defined period of time for the product or service that we're desiring to develop. And so in this example, let's think of a product that we're going to sell over a 5-year period, and we've developed a sales forecast for each of those 5 years as given on the slide. Year 1 is 10,000 units. Year 3 is the maximum year at 75,500 units. And then it starts to decline from there. And in year 5, we sell 25,000 units. Over that same period of time, we've calculated that the cost of producing a product, a unit of product, varies year by year because the number of units we're selling and producing varies year by year. And so in year 1, the cost per unit to make the product is $2,500. In year 3, where we have the maximum number of sales, the cost to produce is down to $1,500, and then as volume declines, the cost to produce starts to go back up. And so given that kind of data, what price would we put on the product such that we could generate a 20% return on a $12 million investment to develop and produce that product? Well, first of all, a 20% return on $12 million would be $2.4 million. And so we know that over the 5-year product life of this product, we're going to have to pay back the investment and generate the 20% return, which means we need to pay back the $12 million investment, generate the return of $2.4 million, which means the income stream we're looking at has to be $14.4 million. Now, does this mean that we nominate a price for the product, figure out all the yearly net incomes, and then just add them up and keep changing the price until the sum of those net incomes is $14.4 million? Well, that's close, but it's not correct. Because if we do that, we would be underestimating the price of the product. And why is that? It's due to a commodity known as the time value of money. And what the time value of money tells us is a dollar received this year or today is worth more to us than a dollar received next year. And that's because effects like inflation, possible devaluing of currency, as well as the opportunity cost of waiting to receive a dollar next year, means overall a dollar received today is more important to us than a dollar received next year. After all, if we receive a dollar today, we can do something with it. We can't do that if we have to wait till next year to receive the dollar. And so to describe that time value of money, we attach something called a discount rate to our calculations. It's the rate at which the value of the dollar decreases year over year over year, or period of time over period of time. Selection of that discount rate is a little bit subjective, but it should represent our expectations for inflation, our expectations for how much it costs us to borrow money, and our expectations over maybe some opportunities we have if we had money today versus next year. So let's look at at this example in more detail. In our rate of return calculation, we need to replace total net income with something called the present value of net income. What that means is we can calculate the present value of a future stream of income using this formula, where the cash flow or net income for a specific year is divided by 1 plus R, where R is the interest rate or discount rate we talked about. And that 1 plus R expression is taken to the nth power, where N is the period of the cash flow. So in year 1, N would be 1. In year 2, N will be 2, and on through the 5 years. And the challenge here is to set the price such that the present value of all the cash flows for the 5 years will come up to that $14.4 million we need to pay back the investment and generate the return. So, given our forecast of sales, given our forecast of product costs, we need to find a price that generates that present value of the future net income streams that are equal to $14.4 million. Now, a convenient way to do this is to use an Excel spreadsheet, and we'll go through now and show you how you can set up that calculation on Excel. So this is how we can set up an Excel spreadsheet to help us do the calculation of what price is required to generate a present value of net income that's equal to our investment and to our return. And so the way we go about doing this is to, first of all, set up a cell where we list our investment amount, in this case, $12 million. We enter our return rate in another cell, and using these two, we can generate the desired return, which is $2.4 million. We can then add that to the original investment, and this gives us the amount that we're looking to pay back by the generation of income. For this example, we've chosen our discount rate, that's the R in the cash flow formula, to be 6.5%. It's a subjective calculation of what we think inflation is, as well as the borrowing cost for this $12 million. And it tells us how much the value of a dollar decreases year after year after year. Now, the main part of this is to set up a calculation that allows us to change the price per unit so that we end up with a sum that equals the desired return. And right now, I'm going to zero this out. And so now we see that the sheet is blank and now ready for calculation. Okay. So the way we've set this up is what we want to find is the price that will give us the desired present value that we're looking for. We've entered the forecast, sales forecast numbers. From the forecast numbers and the price, we'll calculate what the revenue is every year. We've entered what the cost of manufacture per unit is. And again, taking this cost per unit times the units sold will generate what the total cost is every year. And then that will allow us to calculate what the net income stream is for every year of the 5 years. Down in these cells, this is where we'll take the net income number and we'll plug in the formula cash flow divided by 1 plus 0.065, that's the discount rate, to the nth power. And in year 1, that'll be a 1. In year 2, that nth power will be a 2. And likewise for 3, 4, and 5. And then we will sum up these present value numbers to get the total present value of these net income streams and try to get this number as close as we can to our desired payback amount. So let's enter a price now of, say, $2,000 as a sales price. Okay. Okay, so we've got the 2,000 in each of the pricing cells, and now we see what the present values are down here on the bottom line. In year 1, with that price, we'll generate a loss. In year 2, with higher sales, we'll generate positive net income. Year 3, a large positive net income, and then it declines after that. The sum of the present values of those net incomes is $36 million. which is a lot more than what we're looking for. So this tells us we can go back with a lower price. So let's put in $1,500. And now we've got $1,500 as the price. And now we have the following net income streams. Well, now we see that the sum of the net incomes is in fact negative. And so we're way below where we want to be. And so we need a higher price than $1,500. So let's split the difference and make it $1,750. Okay, that's better. Now we're at a little bit below zero, but it tells us again we need a higher price than that. So let's go with $1,900 as the price. Okay, now our sum of the net incomes is $20 million. Okay, now we're a little bit over. So let's split the difference at $1,850. Okay, we're getting close, but now we're a little under. And so I'm just going to input a number, $1,866 as our price. And look at that. We're now at a present value of net incomes of $14,456,000. We want $14,400,000. That's really close enough. And so what this calculation has told us is that if we price our product at $1,866, we will generate a present value of the net income streams year after year that's equal to paying back our investment and generating our return of $2,400,000. So, to summarize this subject of rate of return pricing, first of all, gross margin is a perfectly fine key performance indicator, or KPI, for pricing and profitability in those cases where the investment to create a new product or service is relatively insignificant. But for development projects which take significant investment, our pricing strategy or our pricing may need to be analyzed in a way that ensures an adequate return on our investment. And this is particularly true when we're taking a multi-year view of product costs and forecasted sales, where income streams are coming in over a period of years. And so in these cases, calculating the present value of those multi-year cash flows or net income flows provides a good check on the proper pricing we need to ensure an adequate return on the investment that we would make in order to develop that product or service.
I hope you can see that this is pretty important stuff. In fact, it's so important that these kinds of considerations and calculations need to be a part of the business planning before you start a costly new development project. Think in terms of 5, 6, or 7-figure projects. Because if you're going to generate a good return on your invested capital or borrowed capital, you need to focus on projects that are going to show the potential for generating the returns that you're looking for. In fact, businesses around the world discard new projects every day because they don't show the requisite returns they're looking for. Now, that's what we need to do also so that we don't get ourselves into the situation of funding projects that don't meet our standards for capital efficiency or investment return. Now, the good news is these kinds of calculations and evaluations can take a lot of the guesswork out of determining which development projects we want to fund and focus on. I hope now you have some insight on how to evaluate big development projects. But in the meantime, don't forget to hit that subscribe button so that you don't miss a single video. And as always, I look forward to seeing you again.